Good morning, good afternoon, good evening, no matter where you are in the world. This is Howie, and I'm here to help you win with money. In today's episode of Back to School 101, we're going to talk about market cycles, stock market, investments, doesn't really matter, just market cycles, economic stuff. We're going to try to explain what the correlation is from and how the business world works and how it impacts your investments. Here are the normal economic cycles. Generally speaking, most people just call it 4 phases and it just repeats all over. I'm not going to talk a lot about it, but basically, as you go through a growth cycle, everything is growing, the economy is growing, people are happy, people are spending money. When you get to the peak, you'll see the inflation will pick in, wages start to increase, people start worrying about where things go because once you keep on going up, there is a saying, there's nowhere else to go but down. And an economy is the same thing, right? If you're doing so well, can you keep on growing forever? And the answer is no. So at some point, you hit this thing called a contraction. So if you're growing at, let's say, 5% a year, at some point, if your business only grows 2% next year, you still grew, but you grew at a slower pace than what you did for the last several years. So that's what a contraction is. And at some point when that happens, businesses start preparing for layoffs, they reduce headcount. You know that the economy is going to change, so companies start reducing headcount. And then what happens is when people start worrying about their jobs, what do? They eat out less, they're not going to buy boats and expensive cars, they start saving their money because they think I may be next to get fired. And that happens, and then you see it. Then you go towards this downtrend where now everybody is worried how long this is going to last. Man, maybe your neighbor lost their job, maybe you lost your job, but everybody's feeling it. You tighten your belts. You hope this don't last too long because if it lasts any longer, it's going to hurt. And this is what happens. And when you're near the bottom, what happens is you get to this bottom, and at some point, the government want to step in and they help the economy grow. And today we see how the Feds does that. They reduce interest rate to near zero. They lend or they give money out for free to stimulate growth. And then now you're preparing for the next cycle. And in this chart, which is a much easier way to describe it, how does the business cycle this is the business cycle, the economic cycle is in yellow. So here you go, you're going down. This is the bottom. And then as you start building, there's a growth. Then you're in middle recovery, or that's the growth part. And look, when the economy is growing, you get to the point where you're going to peak out. So there's a lot of inflation here. Everybody's happy. Everybody's spending money. You're taking vacations. You're collecting debt again, right? Credit card debt is growing. And at some point, you're going down and there's a recession. And this yellow one goes here and it continues here. And then you eventually get to the bottom and it repeats all over. Now, when you overlay that with the stock market cycle, what's interesting is stock market cycles are like this. You hit a bottom, and then the stock market sort of predicts that there's going to be a recovery at some point. And what this chart is telling you is invest in item number 4 and 8. Which is financials, and 8 is transportation. Because what that means is, during this part, you know that the economy is going to pick up. You want to invest in things that will grow. Then, in number 5, it's saying invest in technology companies. And then 7 is saying invest in capital goods. Now, at the late bull cycle, you're saying invest in basic industry. Most people are now investing in energy and utilities because they want safety. Because once you're here at the very top of the market cycle, people are rotating out of stuff that they made money in, which makes sense. Utilities and energy is a safe play, precious metal. And look what happens here. Once you're at the top, now you're downtrending. So what do people invest in? Healthcare, because they think it's recession proof. They're preparing for the what's to come. And so the bear market starts, and then what this chart is telling you is number 10, people are investing in utilities here, because you want a dividend. You're going to keep on paying your electric bill no matter what happens. And then it keeps on going down and down and down. And then at the very end of this, look what people are doing. And towards the very end of the late bear market, investors are always forward thinking. So they're starting to position their money in other stuff because they're preparing for this next cycle of a recovery. Now, how does this work in real life? A lot of people who understand this, sometimes they invest using sector rotations or they move money in and out of things. So now, here's the most common ways that people view the world. There are people who don't invest, so market cycles don't really matter. What they're worried about is, do they have a job? Will they be able to afford their lifestyle? They're living paycheck to paycheck, and they're just trying to stay alive. They're trying to keep their head above water. They're not too interested in everything else. They don't have to worry about assets. They don't really have much. There are other people who buy at the peak. They have poor market timing. They panic sell. And it's always this up and down. They seem late to the party. And then late to sell out. And then when the market recovers, they're late again. And it just repeats. And it's just hard. And you can see that with the .com. People buy into these unprofitable businesses. Everybody is pouring money in. And then what happened? It crashes. And they still believe it's going to come back. And people lose money. And there are some people who've been losing money in .com for a long time. After that crash, 5 years later, they're still feeling the pain. This happened at the housing crash. People buy multiple homes, got in, thinking it'll never go down. Everybody was making money. Having one or two houses was just not enough. Buy another one. And then when it goes down, people lost money. End up losing a lot of money, and it hurt. How about the COVID crash? March 2021, there are people who sold out thinking that, hey, this is the worst recession ever. COVID shut down everything. There was no travel, no concerts, can't go to the restaurant, you can't leave, no one was on the roads driving. I remember not even filling up my car gas in like 2 months. There was nowhere I went. I basically went to the grocery store once a week to buy groceries, and that was it. Then there's another type of investor, those who only dollar cost average. They're doing fine. They're always going to buy regardless. Or how about the buy and hold investors? And then there are folks who love recessions and downturns. They seem to always have money to take advantage of opportunities when no one else wants the assets. They just seem to always have good timing. So let's look at some of these examples and how it impacts an investor's mindset. So the first one I want to talk about is, let's look at Microsoft. What if you have the worst timing in the world starting around here, right around the .com? So let's take a look at that. I loaded up Yahoo Finance, used the charts, and I wanted to go back a few years. You can see how Microsoft was a great investment starting in the 90s. You definitely outperformed. Look at this. You outperformed the S&P easily. You're up 800-900%. And look at this. The market peak right here. Microsoft went from literally a few dollars a share all the way up to about $58 a share right here in 99. And then it sort of hit that number again right around March of 2000. And then after that, sharp drop. But let's follow this chart and see what happened. Look at this. Microsoft was downtrending. So this is when the .com happened. Everything crashed. And look, all of a sudden, no one wanted to buy technology companies. So if you were a buy and hold investor, you could have felt really bad owning this thing here near the peak. In fact, you could have been holding this for, look how many years you had to hold it. You were feeling a lot of pain. In fact, most people may have even insulted you by saying what a horrible investment that is. But let's keep on scrolling and see what happened. If you keep on scrolling, you'll see that Microsoft then underperforms the market. Another crash here. This is the housing crash. Has nothing to do with Microsoft. You would think, why in the world will Microsoft stock go from $35 all the way down here when Microsoft was $15 a share? Do you see what I see? So let's see what happens. If you bought in that little gap here, let's just scroll, look, let's just scroll right there. Boom. I have no idea why Microsoft went down if you're losing your house, but you can see something interesting. There's money to be made. You would have 10 extra money if you got in at Microsoft. What's even funnier is, let's go back. Let's suppose you're the worst market timer in the world, which means you bought Microsoft right around here. You see this? I'm going to scroll it where right around there. We're going to zoom out just a tad. Look, let's go back to the worst market timer in the world. Like that. And then look, we'll just scroll it right. I want to get it right near that peak there. Right around there. You see that? I'm near the peak. Right around. Let me try to get it near. It's so hard to get exactly near the peak. But I'm trying to find that. You see this? Let's try to get it right there. Okay. So if you bought there at the peak, it was $58. You see how it's showing me $58? You will have not break even until right around here. You see the date? We're talking about 2016. Now, if you were a buy and hold investor, it would have meant that you would have to held this for about 16 years just to break even from the last peak. Now, if you're buy and hold, you're collecting dividends, so it's not a bad thing. Even if you have the worst timing in the world, you bought at the peak, you would have made money after this point. Now, today you look like a genius because look where it is today, relatively speaking. And I'll zoom out a little bit so you understand what I mean. Let's just zoom out a little bit here. So if you bought here, you see how long, if you look at the arrow, the line shows you that's where you have to, right here where that line crosses is where you have to hold before you made any money. Now, if you are dollar cost averaging, it means you are buying a little bit every time over these last 16 years, and so your cost base is actually lower than this. It's actually going to be somewhere down here, and which means you could have broke even a lot sooner. So this is why investing matters. What method you choose doesn't really matter, but if you invest for the long term, you're going to make money. Whether you're doing a stock like Microsoft or even the S&P 500, you're going to make money. That's why I wanted to show you this. So this is why when you look at the news today, you should be happy about the next recession. And today, you see, the market started to go down. There was a lot of news about Russia may invade Ukraine. They may do it during the Olympics. We don't know what's going to happen, but the market's reacted and everything is down. You see all the stocks are down now. Some of them were green earlier today, and now they're all red. If you're not retiring next year or the next couple of years, you should be like me. You should celebrate. This is a great thing to happen. And it's hard to say that because we're so conditioned to say, hey, when the markets are up, we feel good. When the markets are down, we feel bad. And I want to challenge your thinking. Do not think that way. In fact, you should say, while I'm not retired, if the markets are down, that is wonderful. Gives me a lot of time to collect a lot of assets at bargain basement prices. And when I'm 5 years away from retirement, 4 years, 3 years, or 2 years away, you do want markets to go up. Because ideally, right, in a perfect scenario, and you can't time this, but near your retirement age, you will want the assets to be worth more than the 10, 15, 20, or 30 years where you started accumulating the assets. That's how you make money in investing. With that being said, hey, I hope you enjoyed this video. Check my playlist for some other stuff that I have made. I talk about investing, drips, dividends, dollar cost averaging. I talk a lot about options trading. I have a lot of videos on a lot of financial topics. Check out my playlist. Hey, don't forget, please support me. Give me a comment, give me a thumbs up, subscribe to my channel. Somebody can benefit from these videos. Share these videos with your friend. And let's help YouTube algorithm help people find my videos. Thanks again for everything. Hey guys, love you. If anything, hey, let's do this together. Let's do this $1 at a time. And as always, have a profitable day. Bye-bye.